Covered call. Sounds simple. I own some stock. I sell a call. Collect some income. Rinse and repeat. Is it that easy? Let's find out on the Trader's Workshop after the bell. I should have been a cowboy. Anyway, good to see you boys. How are you?
Good. How are you, Lex? How was the summit yesterday?
Unbelievable. It was great. Great crowd. Great everything. No hitches except for one little one toward the end. Yeah, it's always the geniuses who struggle sharing a screen. You know, super techie can write infinite code and can't share a screen. I always love that one. But no, otherwise it was fantastic. So it'll be. Yeah, go ahead. Sorry.
No, I was about to say, after the summit yesterday, you're following up with a show today. You're like Yoshinobu Yamamoto coming in the day after he pitched 7 innings.
Right. I'm numb. I got to do this again tomorrow too. Go figure. Yeah. So you can get that summit if you want to watch the replay on the Tradier Hub YouTube or at the Tradier Hub, hub.tradier.com. Don't forget to sign up. It's free to go there. And we're going to have some cool things coming up. We're already talking about a live summit in Miami, potentially. So all of you guys who listen to us, we're going to have a live version of this down in Miami in the new year, 2026 sometime. But you got to kind of be a member of the Hub to get the information. Hub.tradier.com. It's free. Okay. So good to see you guys. Mark's in his wine cellar. I love it. We're talking covered calls today. Let me just lay this up. I know you guys have maybe a little different opinion on it. We'll find out. I think retail public, it's known as the income strategy. If you have a portfolio of long stocks, and it's a way to enhance your income. I'm just going to leave it at that for now. I know we're going to debate that one. Is it as simple as just finding a call, selling that baby, and rolling, rinse and repeating, blah blah blah? Guessing it isn't, but who wants to tee this up right now? And we should explain clearly, I didn't do that very well, what a covered call is. So who's first? Mark, Jason? I'm going to let you guys fight it out.
I mean, I'll take what is a covered call. That's pretty easy. A covered call is when you own, most often, 100 shares of a stock, and then you sell a call that is out of the money. The purpose of it is, technically, you're supposed to sell the call at the area where you would take your profits normally, like where you would sell your shares. And if it gets above that call, you get exercised. If it doesn't, then you're collecting the premium on the call. Unfortunately, though, the downside, it doesn't help you with a stop alone. But I mean, that's what a covered call is.
Okay. All right. Mark, any comments or additional thoughts?
I mean, before I completely bash the covered call as a trading strategy, I think I will say that I actually do love it. And I think as a gateway to the options markets, as a gateway to learning about like what options can do, the way they behave against stock, the way they behave on their own, like I think the covered call, like there's a reason that's a level 1 options trade. And I would absolutely encourage anyone who is unfamiliar with options to start there. So. Okay. I think there's a lot to be said for covered calls in terms of a relatively safe, very equity-like kind of risk profile that's just great for beginners to get started with options.
Right. So Doug just said this. Let me put that in. Thanks, Doug, for that.
Yep, I think Doug nails it there. I mean, like the idea that it's income is kind of, I think, one of the toughest pillars to follow that the general marketing industry around options wants to push this idea that it's income. And it's not. It's a premium for bearing a risk. And that risk is your upside. And the reason you own equities is because they have a distribution both up and down. And if you're willing to give that away for a specific price, you got to be damn sure that that's the right price.
So here's one of the points I always get, and the ones I always argue about. Let's say you own the XYZ stock, ABC stock. You love it. You want to be a longtime owner of it. And you sell this upside call. And let's just say you sell on average, the 30 delta. Again, there's no rhyme or reason to that number yet, but let's say that's the one we pick. And let's say the stock does become better for you and it appreciates and it goes up, runs through that strike. What do? Okay. Do you let the call, your short call, wipe out your shares, or do you roll it up and out? One of them is going to have a tax consequence, right? And one of them is not. So, and someone debated this with me that you said they let it expire and sign and wash it out and you're done. I'm like, really? Do you do that? I don't know. What if you're still bullish, right? And you want to move it to the next higher strike and you don't want the tax consequence. You have unrealized gain. Any thoughts there?
I mean, I'll give it a little bit of thought. The covered call, you're technically supposed to sell the call at the price that you would sell the stock at.
Okay.
And that's like, I mean, when I used it, I don't use it as much anymore, but when I use it, that's the thesis. If you want to sell Tesla at 450, then you sell the 450 call. You have to, there's a reason why Tesla, you wanted to sell it at 450. Unless that reason has changed, unrelated to the call strike, then I would let it go. But that's more like a trade planning thing, because you don't want to sit there and keep rolling up the covered call and say, oh, I was just kind of cheating. I still want to keep this. I just trying to get more income. I still want to keep this. But covered calls. And for that reason, I don't like to use it. The premiums also are usually not that great because a lot of people cover with calls. So the prices on those calls tend to be low. And that's kind of where my, heartache kind of stands for it. Is it's not that good of a deal. For the most part, it's not that good of a deal.
Okay. Yeah. Mark, you feel the same way, or because I know you don't like the covered call as a strategy either. Or I shouldn't say either, but you don't like it as a strategy, right?
I think narrowly defined, it can be an interesting expression of a thesis, but sort of to Jason's point, right? Like where you're selling that option, you have to be good at both picking the level of the stock, the direction it's going, the magnitude of that direction, and the timing of that direction, which are like three pretty complicated things, to expect out of any single person versus the market. So I have to, generally assume that they're fair, and that I think a lot of the problems I have with covered calls is that they're too broadly used as a panacea, right? That that can make sense to, sell upside, own a little bit here, like that. There's nothing wrong with that profile per se. It's just that always expecting them to generate income or provide the perfect way to have long exposure and get a little, it's not a panacea.
Okay, but it sounds like it can be used in a portfolio for someone, especially more of a beginner, to supplement or help with some income. Assuming there's not an explosive upside move.
Yeah,
most people aren't expecting that anyway.
So with ad deum funds, pretty much what I do is I sell a covered call, but then I also buy a put underneath, and I use that premium for buying the put. It's called a collar. So I guess you could say the covered call is half of the collar. And the reason why I do that is because, I'll get scoffed at from the options people, but it's easy to sell. Like a person just simply wants to know, I can't lose more than 2%. And I can't gain more than 4%, 5%, or whatever in this certain time frame. And it's easy for them to plan and to kind of to meet their goals, their financial goals, without putting their capital at risk. And so I use the covered call to pay for the put. So it's like kind of insurance. I'm trying to mitigate my downside, but I'm also paying for it by mitigating my upside as well.
Mm-hmm.
And
that's okay. You can own the 2% out of the money by only selling the 4% out of the money call.
Yeah. So what? Okay, I get all that. What do you say to the? Which this is a big strategy, and some of the educators in the space use it exclusively. The wheel strategy. So that is selling a cash secured put, collecting income, collecting income, collecting income. You get assigned. You don't care. You want to own the stock. Now you whip the call and sell the call against it, get more income. So that's kind of a combo thing using a covered call as well, right? Is there? And do you guys like that play? Assuming you like the underlying stock and it's something you would want to own.
Is your goal to sell education or to make money?
Make money.
Because I think Jason's point is that like these strategies are so popular because they're easy to sell, they're easy to understand, they're easy to appreciate what equities do and like try to layer an option strategy on it. But like at the end of the day, like there's not edge in a strategy in and of itself. There's edge because options are mispriced. Like you can't say that the wheel is a special way to trade and that just by buying these or selling these puts and selling these, like there's nothing ipso facto about a strategy that makes it, have positive edge. It's just an expression.
Right.
So I think they sell subscriptions because it's easy to understand, but I don't think they generate, I think they generate transaction fees for the industry.
Wow. Very sour.
No, I think it's a great way to get into it. And that's where I'll definitely caveat all this, like trade a covered call, like take 100 shares of like a low dollar stock, use that as a way to understand options. Like it's a great on ramp to seeing how they behave, but to expect that like this is like just doing some mechanics is somehow a secret key, I think is the huge asterisk that anyone pitching a covered call strategy likes to ignore.
Mm-hmm. Okay, fair enough. Do you to get someone started who's going to try the covered call? And Jason, you said it. You pick your call where your thesis is on where the stock you take the profit on the stock. Any other suggestion on strike price chosen and time frame expiry? How far out do you go? Are you rolling these every week, every day, every month, every 6 months, every 3 months? What is a decent prescription if there is one? What do you guys think about that?
If you're doing this yourself, the covered call is technically a hedge. You are, downside is still infinite, well, I guess until zero. Downside can still make you lose all your money. And now you can't make at the same amount going up. It is technically a hedge. So when you're seeing like $100 stock and then you sell $120 covered call 1 year out, expecting hey, 20% return, I'll be very happy.
Yep.
You sell that call. If that stock goes down to 50, the premium on that $120 call is not going to be 50, right? It's going to be something like 5, right? Mm-hmm. So you're only really collecting money and breaking even down to 95. I do understand, like for slow moving stocks or ones that the implied volatility is way higher than the realized volatility, it's a good move, right? Mm-hmm. However, I kind of go a little bit toward Mark, where just doing it and saying I'm making tons of money because I'm doing it is not the way to look at a covered call.
Okay.
Yeah, maybe another comment on sort of strike and time selection is I think there's a lot of temptation to trade a covered call or a wheel or any income generating strategy really with weekly options. You don't necessarily see it with zero DTEs and the dailies, but like there's a lot of momentum behind weekly covered calls because, hey, now there are options listed every Friday that I can sell across several hundred different names. But I think one of the pitfalls of that is the arithmetic on how that theta is going to decay and how much premium you're getting in that short-term option is relatively well priced. Like the markets and the participants and the dealers and everyone know what the decay curve looks like. So there's not necessarily free money there by doing it more often, even if the arithmetic looks juicy. Mm-hmm. Like a big feature and why I don't like doing the weeklies and why I like, to the extent that you want to get involved with this, pushing it out to 30 days, even 60 days, is that when expiration comes, you're defining a point in that stock's path. And we know stocks follow a Brownian motion of randomness and whatnot. And so the more you're trying to slice that up, the more you're going to get cut up with, buy low, sell high, like, or the opposite, sell low, buy high, right? That, like, as you're trying to slice that ever finer, you have to get much more precise with your pricing of that, which I'll say is effectively impossible. And that you want to go towards that 30-day where you get a sample of 22, 25 trading days for path to kind of wiggle its way out, and not just be, trying to chop that up every week.
Interesting. Okay. What else can we say about this covered call? And we haven't done this yet, but Mark, you and I, we deal in synthetics a lot from our old days. This covered call is a synthetic short put, right? So whatever strike you choose, you are selling that put synthetically. Okay, so pick a random number. Let's say we have a $50 strike, and your stock's trading 45, and you sell the 50 call. You are selling the 50 put with the combo of the long stock and the short 50 call. That is a short 50 put. Okay, they're synthetically the same, right? So if you bought the actual put on the 50 line, you would have a conversion, which means that you have bought real stock and you have sold synthetic stock on the three components, and you are perfectly hedged. I mean, perfectly in quotes, because weird things can happen that are beyond the scope here for now. So a lot of people don't get that, and you can actually price that call based on what the put's trading at, right? Less some interest and dividend kind of calculations that you have to throw in there. So does anyone ever ask you guys about that when you're talking to some of your clients about what the heck this is, or do you even offer it? Because it's kind of more of a market maker kind of thing, right?
Nobody has asked me about
that. No one. It's the same. I wish I don't have my little remarkable. I could draw it, but we could look at the mathematics of it too.
The thing is that the average person, I would say, if you understand even 75% of what we're talking about here, you are in the top 10% of all of humanity living right now in options education. So, even with the covered call, the easiest one, and that rest of that 90% is just looking, and they just need something that they can understand. We start saying stuff like premiums and theta and Greeks, and it's way over their head. They just want to say, I need to define my risk. I want to, it kind of helps with stuff like diversification and stuff. If you're going to diversify doing 20 stocks, all 20 stocks can go down, right? Like it's right. So in certain ways, it's very helpful for a retail client to understand what they're getting into. Now, Mark is also right in that the industry takes advantage of that by charging the transaction fees, and it's kind of a builder for something like that. But from the retail standpoint, they're just looking at this and saying, I can, they can explain it to their friend or their family member or their wife or whatever, their husband, and they can say, we won't lose more than X this year in this account. And that's all they really need to know.
Yep. Right. That's fair. I think I always wonder for the retail options trader, how intricate their knowledge has to be successful. I guess intricate is a weird word. You know what I mean? How deep do they have to go? Do they really have to know synthetics? Quite frankly, probably not.
No, probably not. But I think it's more like, it's kind of like a casino. Like, how long do you have to stay in the casino and win before you lose, right? Eventually you will lose. And if you don't have any idea on what premium, what implied volatility is, and then you just keep buying options, you'll win maybe even a bunch of times. So they're just buy calls, click, click, click. But then eventually you lose. And, without good risk parameters or without good knowledge of what you're actually buying, like, if you're just basically price agnostic and you're just like, I think the market's going to go up, call, without that, I mean, eventually you will lose.
Okay. All right. Anything else, Mark, on this thing? The covered call, I think we kind of covered it. We got expiry we talked about. We talked about strikes to choose. We talked about why we hate it. We talked about why we like it. We don't love it. We just like it. We talked a little bit about the wheel. What are we missing here? Anything? I think we're good, right?
I think if you haven't traded an option before, the best thing you can do is sell a covered call. Don't buy a vertical spread. Don't sell VIX puts. Don't do a covered call on a low dollar stock, put $1,000 in there, sell a call, see what it looks like, and watch that happen. I think that's an incredibly powerful way to understand options.
Mm-hmm.
Just don't do it systematically and expect anything other than to bleed transaction costs.
Right.
And
okay.
the markets are really liquid. That's an amazing thing we can all lean on, that your expected negative value is basically just transaction costs, spread costs, to the extent that there are execution fees, all that. Markets are very liquid and very good at pricing these things. So you're not going to blow up by getting, completely, trading a mispriced thing, selling something way too low or buying way too high. The markets are pretty good predictors in that. But your expected value is not an income amount. It's not the premium that you collect. Your expected value is the negative part of transaction costs. So unless you're using that to fund risk transfer or to overcome some other orthogonal edge you have, don't expect anything other than losing that little bit of VIG.
Mm-hmm. Mm-hmm. Okay. Let's take a look at what Lucas said here. Can you be successful as a private options trader without buying and backtesting historical options data? What are you guys' thoughts there? Can you be successful as a private options trader without buying and backtesting historical options data?
I think it depends on what your goals are, right? And I think, sort of what I was just saying there, options markets are great for risk transfer. If you're using it to put on the collars Jason's talking about, if you're using some kind of equity hedging or creating some sort of synthetic structure out of that's a pure risk transfer, absolutely you can be successful in kind of tailoring your equity to your objectives. I think to the extent that you want to start finding more opportunistic trades, then I'm hard pressed to say that you don't need a lot of data and you don't need a deep understanding of what's going on. I think there are successful users of options that maybe have a non-options skill set, to the extent that you're a good stock picker, to the extent that, there's some other fit there. But if you're trading options for options' sake, I think the competition is such that 70 million contracts are going to demand a lot of data from you.
They're going to demand a lot of data from you, is what you said?
Yeah, look at all this volume that's happening. You need to know what's going on, and I think that's backed by data.
Sure. So you're saying, it would help to use a backtesting tool then, or no?
Definitely. And there are great off-the-shelf ones. Our friends at Orats, right? That's a great retail-focused backtesting tool. You don't necessarily need a SQL database of a bunch of historical data. There are some really good off-the-shelf products.
Yeah. Some of the success stories I've seen too are, and you alluded to it or you said it, being a good stock picker. Some of these folks that I've seen do very well have a thesis on a stock direction. Now, I don't know how they get that thesis. It could be a chart. It could be, empirical data that they just have. And options are a great tool to kind of affect a very capital useful theory of your thesis. So if you are just a darn believer that test is going higher and you have X, Y, and Z reasons, the option market is a wonderful place to affect that thesis, I think. And you can do it in a kind of a leveraged way, in a good leveraged way as needed, right? So
especially if your thesis is direction, right? Options, when I say they're well priced, I'm speaking in volatility terms. They don't know anything about the directions of rates other than the implied current value. They don't know anything about the direction of stocks. So to the extent that you're trading an option because you have a directional view, you can be fairly confident, especially the more liquid it is, that that vol you're paying is fair price. So if that vol fits into your risk model, dollars and cents wise, you don't need to worry about what any of the Greeks are saying.
Yeah, agreed. Jason, any thoughts before we head to the hinterland?
Options aren't really a strategy per se; they are a tool. And I don't know how many times people have asked me, is there the same option strategy I could do over and over again every month and make money? And eventually, there are certain ones that you'll make money more often than not, but when it's not, you lose all the money you made. So, they are a tool, just like an equity is, or just like a bond is. Just like cash in your wallet is, right? They are a tool of how you are deploying your capital.
Mm-hmm.
And that, there is, like Mark said, there is no edge in options themselves. But let's say you work at UPS or something like that, and you work in the warehouse and you see the UPS, boxes coming through. You know that there's not as many this time as there was last year at this time.
Yep.
And you're like, you know what? Maybe I should short UPS or something like, or sell my UPS stock or something like that. And maybe you kind of have now an economic thesis. That has nothing to do with the options. You can buy or sell the options however you want. But getting your thesis and staying true to it, that's really, and then trade planning is more important than the tool you use, because the tools overall are all fairly priced.
Yeah.
UPS employees trading UPS shares is neither financial nor legal advice here.
Why not? All right, cool. Speaking of options strategies, I've got to go look at the ones I have on and see how I'm doing today. Is the market? What's the market doing, by the way? I forgot to look.
While you're checking that out, I'll give a little plug for my till because I wrote an article very similar to what Jason was just saying about how, if you're expecting to do the same strategy over and over again, the title of the blog was "Options Trading Doesn't Make Money." Like, options trading itself is exactly what Jason said. It's a tool. It's a way to express something. It's not going out and digging ditches makes more money than options trading does.
Yeah. I feel dour now. I feel sad. I mean, we're beating up options trading, beating it up.
No, we're not beating it up. It's just we're trying to shed light on the rumor that you can just make money just by selling options and not caring about whatever you're doing.
You want to walk in eyes open. If you're expecting options to be anything other than very well priced, you're in for a little disappointment.
Yeah. Yeah, so that means you as a retail person have to have another edge machine, right? It's because they are fairly priced, and your entry and exit into the marketplace is always negative edge. You are not buying bids and selling offers, right?
But very negative edge these days, right? Like that is very slim, which is fantastic, and all the more reason to use them for expressing some other edge or risk transfer or whatever that might be. Like, I actually think it's very positive that there's no edge in options trading, right? Like, if there was edge, that means it would be an inefficient market, and anything you were trying to use these for, you'd be second guessing yourself all the time. The fact that there is no, baked in default strategy means they're really good and useful tools that are highly liquid.
Yeah. So, and that's fair. And then at the end of the day, then you as an options trader, beyond your thesis, whatever that might be, and that could be your edge engine in and of itself. And I don't care if it's a chart or you're just really good at understanding stocks, whatever it is, fundamental data. Then all of a sudden you have to bake in, are you going to be an implied volatility user so that you use the option market to put implied volatility in your favor to affect your thesis? What I mean by that is, are you buying or selling options because of implied volatility levels to see how to kind of make that thesis work? See what I mean? Because you can do either one, right? And most people in the retail world use straight vertical spreads, call debit and credit spreads, and put debit and credit spreads, right? To kind of come up with their the directional sort of bias they may have. Now, one of those could be good in low implied volatility markets, and one can be better in high implied volatility markets. So having a little understanding of implied volatility might help the equation a little bit as well, right? Agree or disagree?
I always kind of say options are the Swiss Army knife of tools, because when you have equity, you just have the buy and the sell button. It's and when you have all you have is the hammer, everything looks like a nail. But with options, because they're a derivative product, you can not just the direction of the stock, but you could also everybody's expectation of how volatile the stock will be. And on top of that, a timing kind of thing. It's a you could take advantage of multiple variables in the market versus something like just buying a straight equity or future or something where it's just one real variable.
Right. Right. Yep. Fair. And you can also straddle time too, right? Calendars, diagonals, all that kind of stuff. So that is also another tool. Yeah, they are diverse. That's for sure. All right, we got to run. Give me the plugs. Let's go, Jason. Mark already got the till out there.
Oh, vol.land for dealer positioning data. Also, November 12th, we're going to be having a live stream. So come and follow my ex at WizardOps, and you will get some information about that. A lot of good guests going.
Good. Mark's harvestedfinancial.com. Is that correct?
That's correct. You'll find all about me, links to the till, links to a bunch of option strategies, and all kinds of fun stuff.
All right, good. And then check us out at hub.tradier.com or send me an email. I love emails. lex@tradier.com. We do demos. We do options talk. It's free. You can sign something up during the week with me and we will chat away. So have at it. Good to see everyone. You guys have a great weekend. And Mark, what else should everyone do?
Happy trading.
Happy trading. All right. See you next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.